Okay, for an example on how to put together a contribution format segmented income statement in Chapter 6, I want to take a look at problem 6-21 on page 270. That one we're going to go through and we're going to actually assemble a couple of contribution format segmented income statements divided up into particular segments. Alright, let's take a look at the company. Company's contribution format income statement is given. And basically we have sales of $750, variable cost $336, gives us a contribution margin of $414 minus our fixed cost, gives us net operating income of $36,000. Now, management's not happy, obviously. Out of $750,000 in sales, we keep $36,000 in net income. What we're looking at is trying to see what we can do to improve profits. If we look at sales and cost records, we've determined the following. Now, we've got different territories. We've got the Northern Territory and the Southern Territory. The Northern Territory has sales of $300,000. The rest of it is the Southern Territory. So the rest of the $750 is going to be the Southern Territory. So we can divide that up appropriately. And then we have the variable cost listed for the Northern Territory as well. And the remaining of it is, of course, in the Southern, fixed costs are 120 and 108 that are traceable to the particular territories, to the segments themselves. So this is the difference between traceable and then common fixed costs, like we talked about. What the problem is asking us to do is to prepare contribution format segmented income statements for, first of all, dividing it up by territory, Northern versus Southern. And then they want us to take that Northern Territory and divide it up by particular products that are sold. I think they call them packs and tips, whatever that is. Alright, so we have to do a segmented income statement that's done in the contribution format automatically. What does a segmented income statement look like? Well, if we go back to the PowerPoint, we see we have a segmented income statement. We have sales in total for the company divided up into the different segments. And then we have our variable cost in total divided up into the different segments. Gives us our contribution margin. Everything's relatively straightforward so far. But then we have to take our fixed cost and divide them into two different types. Common fixed cost and traceable fixed cost. Common, which is common to the company, and traceable we can trace to the individual divisions. What does a traceable fixed cost mean? If we eliminate the division, we eliminate that cost. But then there are some costs that are common. No matter what divisions we eliminate, we still have them. And at the end, we'll have our net operating income. So this is the basic way that a contribution format segmented income statement looks. So we can go ahead and prepare the basic bare bones look of the segmented income statement for the company. And here it is for the company as a whole. We've got the Northern Division, we got the Southern Division. Now the only thing I added, which is a little bit of a wrinkle, is I added percentages. I added these little percents here, okay, which we'll go ahead and talk about in just a little bit. But for a proper segmented income statement, you don't necessarily need those. They ask us to go ahead and put them in this problem. So if you look at the end of number 1, they ask us to put it as a percent of sales for each individual territory and for the company as a whole. Okay, so what do we know about this company? Well, we can start filling in this segmented income statement. We know sales in total are $750,000, right? We know variable cost in total is $336,000, giving us contribution margin of $414,000. Now, we have fixed cost in total of $378,000, but we got a problem. Some of that $378,000 is common, some of it's fixed, and we're going to have to figure out which is which. Okay, so what do we know about the segments themselves? Well, we know the Northern Territory had sales of $300,000. We can plug that in. It had variable cost of $156,000. So we know that we have a contribution margin from that territory, from that division, of $144,000. If we've only got two divisions, and the Northern Division had $300,000 in sales, and totally we have $750,000 in sales, well, obviously, the Southern Division had $450,000 in sales. Same goes with the variable costs. If we have total of $336,000, and we have 156 in the Northern Division, our variable cost is going to be 180,000 in the Southern Division. That would give us a contribution margin in the Southern Division of 270, and 270 plus 144 equals 414. So everything seems to be on track. But now we have to take a look at our fixed cost. Fixed cost can be common or traceable. And what does it say? Fixed expenses of 120 and 108 are traceable to the Northern and Southern territories respectively. So fixed costs of 120 and 108 are traceable to the Northern and the Southern respectively. So that would give us a division margin for the Northern Division of $24,000. For the Southern Division, it's $162,000. Now, the Northern has 120 in fixed costs traceable to it. Southern has 108 in fixed costs traceable to it. Total traceable fixed costs are going to be what? It's going to be 120 plus 108. It's going to be 228, which would give us a total division margin, the different margins of the divisions added together, of 186,000. Now, how do we get the common fixed costs? Well, what do we know? If we look at the income statement that's given in the book, we know the total fixed cost was 378,000. The traceable fixed costs added up to 228. So if we take 378,000 minus the 228, we end up with common fixed costs of 150. 228 plus 150 is the total of 378,000 in fixed cost, which would give us our net operating income of $36,000. And that is our basic segmented income statement. We put it together and we take a look at it. Now, it asks us to put it as a percentage of sales as well. That's why I got these little columns in here. Now, this is a little bit different from what we did before with a contribution format income statement. We're going to be doing it as a percentage of sales for each individual one. And this is kind of just peculiar to this particular problem. Okay, so the variable costs are what percent of the sales? Well, it's going to be 336 divided by 750, or 45%, which would give us a contribution margin of 55% at the end of the day. We can then do that for the different divisions as well. For example, the 156 divided by 300 is 52%. 180 divided by 450,000 is 40%, giving us 48% and 60% respective contribution margins from each individual division. And then as a percentage of sales, we can go ahead and take our traceable fixed cost, giving us percentages of the division margin of 36 and 8% for the Southern and the Northern. And then we can fill it in for the company as a whole. So you can do that. It asks us to do that in the problem where you fill in the percentages, and we can take a look and analyze this contribution format segmented income statement and see what we have going on. Now the problem asks us to take a look at that Northern Division and divide it up a little bit further. Divide it up by particular item that they sell or product that they make and sell. So we see the Northern Division has two different types of products. You got the packs and the tibs, whatever those are. Now the sales are 50,000 for packs and 250,000 for tibs respectively, giving us a total of 300,000. We knew we had a total of 300,000, and we just broke it down to the two different products that we do. We know variable costs in total for this particular division were 156,000. Where did we get that from? Well, we can scroll up and see variable costs were a total of 156,000 for the Northern Division. Okay, now the book goes on to give us a little more explanation of the variable costs. Variable expenses are 22% of the selling price for packs and 58% for tips. How would we do that? Well, variable costs are going to be 22% of 50,000 or 11,000. And then for the tibs, it's 58% or 145,000. So we know what the variable costs are with respect to each individual product. From that, we can get our contribution margin. First of all, in total, it's going to be $144,000. And for the first product, we're going to have contribution margin of $39,000. And then for the other one, be $105,000, adding up to the $144,000 in contribution margin. So it goes on to explain what the traceable fixed costs are for each one. For the packs, it's $30,000, and for the TIBs, it's $40,000. And from there, we can get the total traceable fixed costs of $70,000, and then we have our respective division margins. It's going to be 39 minus 30, or 9,000, and then we got 105 minus 40 for 65,000. So our division margins are going to be a total of 74,000, which is 9 plus 65. Now, we need to figure out how much we have in common fixed cost. Well, where would we get that? What were the total costs that Northern had? We know 70,000 of our costs are traceable, but what was the total amount that we had for this particular division? Well, if we look up, the total fixed costs we had for the Northern division were 120,000. So, if the total costs were 120,000, 70 of that is traceable to each individual product. How much of that is common to that particular division? That would be 50,000. Those two add up to the 120. So, if that's the case, then we have 74 minus our 50. We have our net income of 24,000, which is our division margin. 100%, 100%, and 100%. And this is going to be 156 is 52% of that. That is 22% of that. That is 58% of that. And so 30,000 is what percent of 50,000? It's 60%. That gives us, for that particular one, a division margin percentage of 18%. And then for the other product, we have 26%. So, just fill it in. And so here we have a full-on, including percentages, segmented income statement for the Northern division. So we did it in whole for the whole company, Northern versus Southern division. And then we took the Northern division and we broke that down into the two different products. Now the book goes on to ask us, well, what do we know from this? Taking a look at it, what do we know about these particular products, about these particular divisions? Well, we go back to the first one. Who's doing better, Southern or Northern? Well, Southern's doing better as a whole, and they're doing better as a percentage than the Northern. So they look pretty good. So they're both making relatively good money, but what's going on here? We have a lot more traceable fixed costs to the Northern division than we do the Southern division, which is why they give us a lot more in margin, in income from that division. So we know probably the problems are in this division, this one here. So we break that down even further, and what do we know about what's going on inside that division? Well, we got two different products. We got this one and we got this one. We got the TIBs, we got the packs, and what do we know about those particular products? Well, it looks like both of them will make up that $300,000 in sales, but the TIBs makes up the most of it, most of what we have going on. And the variable costs are accordingly, and they're pretty high for that particular product as well. So that gives us contribution margins, and then we take a look at the traceable fixed costs. We see they're not that separate, they're not that different. But as a percentage of sales, the packs is a lot larger. So what do we know? This one's probably not selling as much as it should. So using that information, we can break down where we think the problems might lie. Alright, and that is your basic segmented contribution format income statement. How we break it down. You can break it down first by division, and then take a division and break that down even further by product line. And knowing that will help with the homework problem that you're going to have for Chapter 6.